There's big news on the horizon. President Trump's proposed 2026 budget. And if you're nearing or already in retirement, these changes could directly impact your taxes, healthcare costs, and even your long-term care planning. The good news, with the right strategy, you can adapt and even turn these proposals into opportunities. In today's video, we'll break down 4 of the biggest changes retirees need to know and how to prepare so your retirement stays secure, flexible, and free. This proposal, called the One Big Beautiful Bill Act, builds on the Tax Cuts and Jobs Act and reshapes tax, healthcare, and you guessed it, spending policy. So here are the highlights. Tax cuts made permanent, new deductions for Social Security, but with phase-outs, increased federal deficits driving cuts in programs like Medicare and Medicaid, adjustments to state and local tax deductions, potential reforms in Medicare prescription coverage, and long-term care incentives. For retirees, these changes aren't abstract. They affect how much money stays in your pocket and how you pay for healthcare and how your legacy is preserved. Let's start with 2 pillars of retirement: Social Security and Medicare. Social Security, if you're already collecting, your benefits likely remain steady, but cost of living adjustments, COLAs, could be calculated differently, which means your payments may not keep up with inflation over a 20 or 30-year retirement, and that can slowly chip away at your purchasing power. Medicare, on the other hand, you get some potential improvements in prescription drug coverage, which could mean savings for retirees managing chronic conditions, but higher premiums tied to your adjusted gross income. So it could increase out-of-pocket costs if you're not careful with tax planning. So here's an example. One of our clients had a strong income strategy but hadn't realized how their withdrawals bumped them into higher Medicare premiums. But by adjusting the timing and mix of withdrawals, we actually saved them thousands in premiums. This is exactly why tax and healthcare planning need to work together. Taxes are at the core of this proposal, and retirees are directly in the crosshairs. Lower brackets are extended, which is great news for middle-income retirees between $100,000 and $400,000. And Roth conversions could become more powerful and more affordable under the simplified structure. Now, estate planning, it may shift with higher exemptions, making it easier to pass on wealth tax-free. So here's an example. We work with a couple considering a Roth conversion, and under current tax brackets, the tax bill was kind of high. With these proposed changes, the math looks far more favorable, giving them tax-free income later and reducing their required minimum distributions. At Retirement Capital, we look at these proposals not as threats, but as actually planning opportunities. The way you time withdrawals, conversions, and gifting strategies can mean the difference between paying more tax or keeping more for your lifestyle and legacy. And healthcare is always one of the biggest wild cards in retirement. Expanded Medicare negotiation power could lower the overall drug costs, and new incentives for long-term care insurance and higher HSA contribution limits could help retirees prepare for one of the biggest risks: long-term care. Right now, the average cost of care can exceed $50,000 a year, and for skilled nursing, over $100,000 a year. So planning ahead is essential. Here's an example. A client in their early 60s choose to purchase long-term care insurance now, before health issues arose. If these tax incentives pass, they'll not only have coverage, but potentially tax benefits on premiums, and that's how you stay ahead of the curve. So how should retirees respond? Here are a few proactive strategies. Strategy number 1, tax planning. Manage your adjusted gross income to lower your overall tax bill and reduce those Medicare premiums. Strategy number 2, revisit the order of IRA, Roth, and brokerage withdrawals because your withdrawal strategy is going to help you minimize lifetime taxes. Strategy number 3, healthcare planning. Consider HSAs, Medicare supplements, and long-term care insurance while you're actually healthy. Don't wait until it's too late. Strategy 4, estate planning. If exemptions rise, review your trusts, review your gifting strategies, and make sure you have charitable plans that will maximize the overall impact. Strategy 5, last but certainly not least, portfolio positioning. You need to adjust your investments for potential volatility tied to deficits and spending changes. And at Retirement Capital, we help clients integrate these moving parts into one cohesive plan. So you're not reacting, you're actually adapting. So here's the takeaway. Trump's 2026 budget brings a mix of opportunities and, with anything, challenges. Both proactive planning, you can stay ahead, protect your income, and keep your retirement lifestyle secure. At Retirement Capital, we believe retirement should be about freedom, not fear. And whether the rules change or not, our mission stays the same, helping you live more life with fewer limits. If this video is helpful, hit the subscribe button for more retirement planning insights. And if you're ready to review your retirement strategy in light of these proposals, book a connection conversation with our team today, and let's make sure you're prepared no matter what comes next.